Welcome to the second episode of the Market Moguls Podcast, the show that dives into the world of the stock market and helps you navigate the ups and downs of investing. Today, we will be talking about Silicon Valley Bank and its recent failure, but more on that later. Get ready to become a market mogul. Markets ended noticeably lower for the week as the Dow Jones Industrial Average dropped 4.4%, the S&P 500 declined 4.6%, and the Nasdaq Composite tumbled 4.7%. With that brief overview of the week out of the way, the rest of the episode will be solely about the Silicon Valley Bank and its failure. You might have heard that Silicon Valley Bank, the 16th largest bank in the U.S., was seized by the FDIC after it was deemed to have inadequate liquidity and solvency by the California Department of Financial Protection and Innovation. To put this into perspective, it is the second largest bank to go under in U.S. history, and it held assets worth over a staggering $209 billion. In more simple words, this is legitimately unbelievable, which is why we are dedicating an entire episode to this failure. Take it away, Susan.
The Silicon Valley Bank was once a leading provider of financial services for startups and venture capitalists. It played a significant role in the growth of the tech industry in the United States. However, in 2017, the bank collapsed, leaving many investors and entrepreneurs in shock. The collapse of the Silicon Valley Bank serves as a cautionary tale for the entire tech industry. In this article, we will delve deeper into the reasons behind the Silicon Valley Bank's collapse and explore the lessons that every tech entrepreneur and investor should take away from this cautionary tale. The history of the Silicon Valley Bank. The Silicon Valley Bank was established in 1983 by entrepreneurs Bill Biggerstaff and Robert Medeiros. The bank was founded to cater to the financial needs of the startups in Silicon Valley. With the growth of the tech industry in the United States, the Silicon Valley Bank became a leading provider of financial services to tech companies and venture capitalists. The bank's success was attributed to its focus on providing loans to startups with high growth potential. It also had a strong relationship with venture capitalists who relied on the bank to provide financial services to their portfolio companies. However, over time, the Silicon Valley Bank began to take on more risks. It started to finance companies that were not necessarily in the tech industry, and its lending practices became lax. The bank began to make loans to companies that were not profitable or had a weak financial position. This shift in lending practices would ultimately lead to the bank's collapse. The warning signs of the bank's collapse. The Silicon Valley Bank's collapse did not happen overnight. There were warning signs that something was amiss. One of the primary warning signs was the bank's loan portfolio. The bank's loan portfolio was heavily concentrated in the tech industry, which made it vulnerable to fluctuations in the industry. The bank's loans were also highly risky, with a significant portion of its loans going to startups that had not yet generated revenue. Another warning sign was the bank's lack of diversification. The Silicon Valley Bank was heavily reliant on the tech industry, which made it vulnerable to any downturns in the industry. The bank's lack of diversification was compounded by its focus on lending to startups with high growth potential. This focus on high growth startups meant that the bank's loan portfolio was skewed towards companies that were not yet profitable. The root causes of the collapse. The Silicon Valley Bank's collapse was the result of several factors. One of the primary factors was the bank's poor lending practices and lack of liquidity, as well as its insolvency. The bank was lending to companies that were not profitable or had a weak financial position. This strategy worked well when the tech industry was booming, but as soon as the industry began to slow down, the bank was left with a portfolio of bad loans. Another factor was the bank's risky investments. The Silicon Valley Bank had invested heavily in high-risk startups, many of which failed to generate a return on investment. The bank's investments in startups were also highly concentrated, with a few startups accounting for a significant portion of the bank's investments. Finally, the Silicon Valley Bank's collapse was also due to a lack of oversight. The bank's board of directors failed to provide adequate oversight, allowing the bank's management to make risky loans and investments. The bank's management also failed to provide appropriate risk management, which led to the accumulation of risky loans and investments. Simply put, the bank failed as a result of a bank run, which is when a large number of depositors all try to withdraw their money at once. This usually is not possible as American banks run on the fractional reserve system, a system where only 10% of all deposits must be kept in the actual bank while the rest is allowed to be loaned out. The impact of the Silicon Valley Bank's collapse on the tech industry. The Silicon Valley Bank's collapse had a significant impact on the tech industry. The bank's collapse left many entrepreneurs and investors reeling. The bank's clients were left with a portfolio of bad loans, and many startups were forced to shut down. The bank's collapse also had a ripple effect on the venture capital industry, as many venture capitalists relied on the Silicon Valley Bank to provide financial services to their portfolio companies. The Silicon Valley Bank's collapse also highlighted the risks associated with investing in startups. It served as a reminder that startups are inherently risky, and investors need to be prepared for the possibility of failure. The collapse of the Silicon Valley Bank also highlighted the importance of responsible lending practices in the tech industry. Results outside the tech industry. With the collapse of any big bank, there will always be an impact on other sectors, and this is no exception with SUV. To start, the failure resulted in USDC, the second largest crypto stablecoin, to depeg from $1. This is bad because the whole purpose of USDC is to stay at $1, so one can be invested in crypto without the unpredictable volatility. Circle, the issuer of USDC, said that it had $3.3 billion in SUV exposure. However, crypto was not the only thing impacted by SUV's failure, as it really affected the entire world economy. Obviously, similarly to 2008 and the dot-com bubble crash, some level of trepidation was instilled into every person and entity. This can be seen with a simple look at other bank stocks, such as Bank of America, Goldman Sachs, and Morgan Stanley, whose stocks ended the day down 0.88%, 4.22%, 2.33%, 3.33%, respectively. Surprisingly, J.P. Morgan Chase, the world's biggest non-nationalized bank, actually ended the day up by 2%. Yet it was not just these giant banks that were affected by the run. Banks like First Republic, PayQuest, and crypto-focused Signature Bank ended the day down as well. First Republic dropped 14.8%, and PayQuest shed 7.9%. Some bellwether bank stocks suffered smaller losses even as SUV's fallout wreaked havoc on regional names. Lessons learned. The collapse of the Silicon Valley Bank serves as a cautionary tale for tech entrepreneurs and investors. Here are some of the lessons that can be learned from the bank's collapse. 1. Diversify your investments. The Silicon Valley Bank's lack of diversification was one of the primary reasons for its collapse. Investors should diversify their portfolios to reduce the risk of any one investment causing significant losses. 2. Invest in profitable companies. The Silicon Valley Bank's focus on lending to startups with high growth potential was a risky strategy. Investors should focus on investing in companies that have a proven track record of profitability. 3. Conduct due diligence. The Silicon Valley Bank's poor lending practices were due, in part, to a lack of due diligence. Investors should conduct thorough due diligence before investing in any company. 4. Be prepared for failure. The collapse of the Silicon Valley Bank serves as a reminder that startups are inherently risky. Investors need to be prepared for the possibility of failure and have a plan in place to mitigate losses. The future of the tech industry and the role of financial institutions. The tech industry is constantly evolving, and financial institutions must keep up with these changes. The collapse of the Silicon Valley Bank highlights the need for responsible lending practices in the tech industry. Financial institutions must be vigilant in their lending practices and ensure that they are not taking on too much risk. The collapse of the Silicon Valley Bank also highlighted the importance of diversification. Financial institutions must diversify their portfolios to reduce the risk of any one investment causing significant losses. Let's wrap it up, Will.
Conclusion. The collapse of the Silicon Valley Bank serves as a cautionary tale for the entire tech industry. The bank's collapse was the result of poor lending practices, risky investments, and a lack of oversight. The collapse of the Silicon Valley Bank had a significant impact on the tech industry, leaving many entrepreneurs and investors reeling. However, the collapse of the Silicon Valley Bank also serves as a reminder of the risks associated with investing in startups. Investors need to be prepared for the possibility of failure and have a plan in place to mitigate losses. The collapse of the Silicon Valley Bank also highlighted the importance of responsible lending practices in the tech industry. Financial institutions must be vigilant in their lending practices and ensure that they are not taking on too much risk. Just to reiterate, on March 10th, Friday, Silicon Valley Bank was taken over by the FTC as a direct result of a bank run, a product of many reasons. Thank you for watching and have a great rest of your day. Market Moguls out.